let's jump right into this explainer and uncover why just memorizing candlestick patterns, it's simply not enough to beat the financial markets today. I mean, if you've ever found yourself staring at what looks like a totally perfect chart setup, you confidently take the trade, and then immediately watch the market reverse and stop you out, well, you are definitely not alone. Today, we're exploring Richard Alcantara's really fascinating book, The Candlestick Trap. We're going to figure out exactly why that happens, and more importantly, how professional traders use volume and liquidity to completely flip the script on the rest of us. We're going to look beyond those simple shapes on the screen and learn how to actually read the massive institutional footprints that are literally hiding in plain sight.
Here is our roadmap for today. We'll start with the candlestick trap itself, look at how volume acts as a lie detector, break down the 4 specific volume states, dissect the anatomy of a shakeout, and then finally look at a mechanical framework to trade just like the smart money.
Okay, part 1, the candlestick trap. Let's look at the harsh reality of retail trading. Get this, a whopping 70 to 80% of retail traders lose money in the markets. And here's the real kicker from Alcantara's research. The biggest obstacle to their success? It actually isn't poor technical analysis. Actually, scratch that. They know the shapes perfectly well. The real problem is poor execution. This overwhelming majority of traders are bleeding capital because of emotional decision-making, using way too much leverage, chasing prices without any regard for context, and, this is huge, placing their stop-loss orders at highly predictable levels. They're basically treating technical analysis like a toddler's game of matching shapes, and well, they're paying a steep price for it.
This perfectly illustrates the grand divide we see playing out every single day. On one side, you have the retail trap. This relies heavily on pattern memorization, hunting for a specific shape while desperately fighting off emotions and dropping predictable stop losses. But on the other side, you have the institutional edge. And this is built entirely on reading the broader context, analyzing volume, and actively hunting for that retail liquidity. Think about it. They literally need your stop losses to fill their own massive orders.
Which brings us to part 2, volume, the ultimate lie detector. To get on the right side of the trade, we have to fundamentally shift our perspective. As Alcantara points out, yes, candlesticks have been relevant for over 300 years, but we absolutely have to stop treating them like magic crystal balls. Instead, think of them as a visual record of an ongoing historical battlefield between buyers and sellers. Today's markets are completely dominated by smart money. So we've got to interpret these candlesticks alongside market structure and liquidity, not just as isolated magical signals. And to do this effectively, the book introduces the volume signature framework. Basically, you want to think of volume as the market's ultimate lie detector. See, institutions can easily hide their intentions in price movements, right? But they absolutely cannot hide their massive volume. So rather than just blindly trusting the shape of a candlestick, we use volume to reveal the true underlying conviction behind every single price movement. This framework is what allows us to distinguish a genuine market opportunity from a false signal that's just been designed to trap retail money.
Moving into part 3, the 4 volume states. Let's learn how to actually read this lie detector.
By applying standard volume spread analysis benchmarks, Alcantara classifies market setups into 4 distinct states. Now, quick note here, you don't necessarily need exact numerical percentages to define these. What you're really looking for are relative benchmarks, comparing current volume to recent historical volume. These 4 states are confirmation, divergence, climax, and apathy. By identifying which state the market is currently in, we can figure out exactly what the smart money is up to behind the scenes. Let's break these down one by one.
First up is confirmation. Honestly, this is exactly what you want to see when you're entering a trade. This state happens when price movement and volume are perfectly in sync. For example, if a candlestick breaks through a key level, or maybe continues a strong trend, and it does so on high or increasing volume, that move is confirmed. That high volume is signaling strong conviction from the buyers or sellers. It essentially tells you, hey, the big players are actively backing this move, making it a highly reliable, genuine opportunity.
Second is divergence. And listen up, because this is exactly where most retail traders get trapped. Divergence is a really dangerous mismatch between the candlestick's appearance and the volume behind it. So let's say you see this massive, beautiful, bullish breakout candle, but the volume is incredibly weak, or even declining. That is a trap. The price might be moving, sure, but that lack of volume proves that professional traders just aren't participating. That means the move is entirely unreliable.
Third, we have climax volume. Now, this state is characterized by extreme, ultra-high volume, and it very often signals either the exhaustion of a current trend or a massive institutional intervention. Think of your buying climaxes or selling climaxes. Climax volume is literally the ultimate footprint on your chart. It frequently marks the exact turning point where institutions are transferring their positions to or taking them from unsuspecting retail traders right before a major market reversal. And finally, the fourth state is apathy. Just like it sounds, this is characterized by a complete lack of market interest, very low volume, and usually pretty narrow price spreads. If you're familiar with Wyckoff analysis, this helps identify no supply or no demand zones. Apathy simply tells us, well, it's just not the right time to enter a trade because the smart money is completely sidelined. If the big players are taking a nap, you probably should be too.
All right, let's put this into practice. Part 4, the anatomy of a shakeout, the ultimate retail trap.
A high-volume shakeout is probably the greatest example of the candlestick trap in action. By definition, a shakeout is a highly deceptive market move where the price deliberately drops below a known support level. Why? To trigger retail sell stops, only to rapidly reverse direction. It's essentially a hunting ground. Institutions artificially create retail panic just to scoop up the liquidity they desperately need for their own positions. Let's look at how the volume signature framework explains this event in 3 distinct steps. Step 1 is the trap. This is where price moves below a predictable support level, literally exactly where retail traders were taught to place their stop losses. And bam, this triggers a massive cascade of selling. Then step 2 is the footprint. Suddenly, we see a massive spike in volume. That's that climax state we just talked about. But here's the catch. The price doesn't keep falling. That climax volume is actually institutional traders stepping in to absorb all that panicked retail supply. And finally, step 3 is the result, a rapid price recovery. The professional, smart money starts driving the market in the totally opposite direction, and the retail traders who just got stopped out, they're left frustrated watching from the sidelines.
So how do we fix this? Part 5, trading like smart money and protecting your hard-earned capital.
You can absolutely protect yourself from these shakeouts and traps by turning this framework into a simple 3-step mechanical check every single time you evaluate a potential setup. Step 1. Identify the candlestick pattern on your chart. Just acknowledge what the market is showing you on the surface. Step 2. Immediately check the volume signature to see if it matches confirmation, divergence, climax, or apathy. And step 3. Use that volume context to decide, once and for all, if the signal is a genuine opportunity backed by institutions or just a false signal designed to trap you.
Ultimately, the big takeaway from the candlestick trap is that profitable trading requires a complete, holistic methodology. You absolutely have to integrate your candlestick analysis with volume, liquidity, and overall market structure. You must actively hunt for institutional behavior and those undeniable volume footprints. And honestly, most importantly, you need disciplined risk management. Stop placing your stop losses at those exact, highly predictable levels that institutions use as their personal liquidity pools. Replacing simple pattern memorization with deep contextual analysis really is your only true path to escaping the retail trap.
So, I hope this explainer has completely flipped how you view a price chart. Next time you see what looks like a totally perfect candlestick pattern, I want you to pause, look at the volume, and ask yourself, are you successfully reading the footprints, or are you about to become someone else's liquidity? Keep that in mind before you place your next trade.
Market psychology and institutional behavior are the true drivers of price, meaning isolated signals are often misleading without contextual analysis. To combat high failure rates among traders, the text introduces a framework that integrates volume analysis as a tool to verify the strength of price movements. By employing strategies like volume spread analysis, traders can identify where major banks and hedge funds are moving liquidity. Ultimately, the source emphasizes that sustainable success requires a transition from simple pattern recognition to a disciplined methodology, focused on risk management and market structure. If you wish not to continue being cannon fodders of big institutions and being part of their liquidity pool, this book will show you how. Get a copy now and turn those losses into profits.